Welcome back to another quick episode of Unpacking Transfer Pricing, a series where break down complexities of transfer pricing into bite-sized formats. For more detailed discussion, refer to the link in the comment section below for an audio-only podcast. Today, we will be discussing Chapter 3 of the OECD Transfer Pricing Guidelines 2022. As a cautionary note, this isn't professional advice, and for specific situations, you should always reach out to actual transfer pricing consultants. It is just for your high-level knowledge. Let's begin. Comparability analysis in transfer pricing involves a systematic approach to identify reliable comparables. It requires understanding the controlled transaction through functional analysis and selecting the appropriate transfer pricing method. Adjustments are made to ensure the arm's length pricing is accurate, following Organization for Economic Cooperation and Development guidelines. This process is iterative, often revisiting steps for thoroughness. The comparability analysis process begins with a broad-based analysis of the taxpayer's circumstances, focusing on industry, competition, and economic factors. Conduct a functional analysis to understand the controlled transaction, identify comparability factors, and select the appropriate transfer pricing method. Identify potential comparables, apply selection criteria, and make necessary adjustments to determine the arm's length range or price. The slide on the screen is based on 9-step process recommended by OECD. Controlled transactions can be evaluated separately or together, especially for long-term contracts or intangible rights. When using one-sided methods like cost-plus or transactional net margin method, select the party with simpler functions and risks, one with lesser complexity to ensuring reliable comparables. Avoid parties owning unique intangibles for accurate analysis. Least complex entity is therefore considered as the tested party. Internal comparables involve transactions between a party to the controlled transaction and an independent party, offering a direct relationship and easier financial analysis. In simpler terms, one company having same or similar transaction with an associated party and an independent party, thereby allowing you to compare the prices and terms and conditions of the two transactions to check the arm's length principle. External comparables, found in databases involving independent enterprises, providing company-level data for arm's length testing. Tested party margins are tested against the arm's length range. Both internal and external comparables must satisfy comparability factors, but comparisons of one controlled transaction with another controlled transaction is irrelevant to the arm's length principle. The additive approach begins with known third parties most likely to have comparable transactions, then collecting information to confirm acceptability. It's useful when specific market players are known, but less common due to potential biases. The deductive approach starts with a broad set of companies, refining through selection criteria and public information, often using databases. Deductive approach is most widely used. Combining both ensures transparency and verifiability. Selection criteria include size, intangible related ratios, and export sales importance. Exclude companies in special situations, such as startups, government entities, long-term loss-making, etc. Comparability adjustments focus on accounting consistency, financial data segmentation, and working capital. Adjustments should enhance reliability, address material differences, and be transparent. Adjustments should not be forced to meet the arm's length margin. Multiple adjustments may signal poor comparability and raise question about the method chosen and the tested party margin. The arm's length range includes multiple reliable results, eliminating less comparable data. Statistical tools like the interquartile range refines this. No adjustments are needed if transactions fall within this range. Timing is crucial. Contemporaneous data is most reliable. Price setting and outcome testing approaches differ, and while multi-year data is useful, avoid hindsight bias. One cannot use data of 2017 for testing margin for 2020 to 2021, since there is a time gap and markets would have undergone change. Example, COVID impact. A pragmatic approach to compliance is crucial, especially for small to medium enterprises and multinational enterprises with numerous controlled transactions. The cost of compliance is a valid concern, so a reasonable effort is sometimes acceptable. Taxpayers and administrations should use judgment to assess comparables' reliability. Efforts should align with transaction size, complexity, and risk, avoiding exhaustive searches. Some countries do provide exemption from preparation of TP documents based on certain threshold or safe harbor. Do consult country-specific guidelines on documentation requirement. With this, we wrap up today's session. Stay tuned for Chapter 4.